Hey guys, Brennan here. Today I thought I'd talk about the damning news from the U.S. bond market. And the U.S. bond market happens to be the most important in the world. It's where the U.S. government issues U.S. treasuries in order to fund their operations. And so the longer dated bonds, they tend to determine the interest rates for mortgages, loans, corporate debt, you name it. It's usually the asset that's traded back and forth in repurchase agreements, as it is, or at least it used to be, classified as pristine collateral. And so these long-term bonds, their yields are starting to go up. And because the yields are going up and the prices of the bonds are going down, that means that investors and institutions and whatever else, they're selling the bonds onto the open market. And that is sending the yields higher. And with that, it's causing issues. Now that's creating a huge problem because that will increase the amount that the U.S. government will be able to borrow in the future if these yields continue to go up, just because the interest that the U.S. government will have to pay will be substantially higher. And with this happening, the bond market is the backbone of all markets. Without the bond market, markets just freeze up. And in the economy that we have today, everything is based on debt. Like without debt, there is no currency. It's like a matter and antimatter kind of situation. And so if the bond market freezes up, lending grinds to a halt, then the economy will start to collapse, where supply chains break down. New loans aren't being created, paychecks aren't being sent out to people, banks start to have problems. It's a very dicey situation right now. And so the U.S. Treasury, they came out, Scott Bessent, the Secretary of the Treasury, he came out and announced that they will be doing a bond buyback program. So this is to basically manipulate the interest rates on the long end of the yield curve. The yield curve is basically it's a curve and a representation of all the different types of bonds that there are, like the 1 month, the 3 month, the 5-year, 10-year, 20-year, 30-year. And so by buying the longer dated bonds, it will manipulate the long end of the curve. So if a central bank were to do it through quantitative easing, which they buy bonds and create a artificial scarcity, that manipulates the yield curve as well. But the Treasury is coming out and doing it and manipulating it. So with that being said, this sets a dangerous precedent for the future, because it just throws a message out there that if no one wants to buy the government's debt, the government will step in to buy its own debt. And so by monetizing the debt, like the central banks have done in the past, it creates a dangerous situation for the bond market going forward, just overall, because bond markets are having problems everywhere right now. It's not just the U.S. And it's to me, it seems like a monetary reset is around the corner. And if you've been paying attention to central banks over the years, they've talked about the new monetary system that they want to bring in, and that's central bank digital currencies. And so what that system looks like is kind of unknown to anyone at this point. Usually when there's so much doubt with the financial system like there is now, this is not this is not my day job. Like, the fact that I'm talking about this stuff just goes to show that there is a lot of doubt for the financial system in the future. And I've talked about it before, how I think some of the main reasons why the financial system is failing right now, like declining birth rates, lower productivity. With the U.S. debt clock reaching $40 trillion, with them hitting $31 trillion not even that long ago, I think maybe within the beginning of the year of 2026, it just goes to show like a lot of faith has been lost in the U.S. government in order to make sure that they're able to meet their social program spending in the future, their interest payments, their defense spending, which their interest payments for their debt has now exceeded spending, which is a huge red flag. People are just dumping these long-term bonds because they feel like in the future the yields for these bonds won't justify the amount of inflation, which that's understandable. If you look at, the price of groceries, fuel, and all that, I don't have to tell you, like I'm sure all of you watching this video understand that. It's not looking good for the current fiat currency system that we have. It's very obvious to anyone paying attention that the system is broken, and so it needs to be reset. And so there's a lot of talk right now with gold being brought back into the system, as lots of these investors that used to be buying bonds are no longer buying bonds. Like a lot of these bond auctions over the past couple of years have not gone well. Like there just haven't been that many buyers, and with the price of gold shooting up like it has in the past couple of years, a lot of investors and buyers are moving towards gold instead of bonds. And that it's not just investors or institutions, it's also central banks. All you have to do is pay attention to their buying rate, and they're buying a lot of gold. And if they're buying a lot of gold, that means, at least I think it means, that there's some sort of reset around the corner, and gold will likely be attached to that reset, and money will eventually have a gold backing again. But the thing is with these gold backings and getting off these gold standards and then going back on them is we do that to inspire confidence in the monetary system, but as time goes on, we eventually deviate away from the gold backing and the gold standard, because it's just too perfect a money for an imperfect human race. And so we spend a lot more than we should, and for that reason there's more currency units than there is gold to back it. And that's not me just saying that. That's from what's happened in history past. And so it's I have a feeling that we're going to see gold eventually become the neutral reserve asset, and U.S. Treasuries will likely no longer be that reserve asset. Same with the U.S. dollar. Like with what's going on with this war right now, it's not looking good. Like the Strait of Hormuz is still closed. Obviously, some ships are making out of the Strait of Hormuz, but it's nowhere near the traffic that it used to be, and a lot of the world's raw materials come out of that choke point. And so let's say there's a famine in the next year or two, which is very likely. JP Morgan came out recently actually forecasting that, where there will be severe food shortages in the future. If you look at the US's involvement with this war, like a lot of people view it as voluntary. Like they didn't have to step in, but they did anyway. And so if that's the consensus, like worldwide, that the US didn't have to do this, and there are these massive shortages of food, energy, raw materials, a lot of people could be dumping the US dollar, and this is how the U.S. Loses its world reserve currency status, because they've slowly been losing that status as the years go by. The U.S. dollar just becomes a lower percentage of the reserves in central banks around the world. And so this may be one of the final nails in the coffin for the U.S. dollar. And so I guess I'd say when the U.S. dollar eventually loses its reserve currency status, then we need to shift to another neutral asset. We need something there in order to prevent the whole system from crashing down, especially with the fiat currency system that we have right now, where money / currency is backed by debt, and it's not backed by any sort of commodity or anything. So if you have a currency system like we have right now, where it's just backed by hopes and dreams and the promise to pay back that money in the future, it makes for a very shaky and unstable financial system going forward, especially if the prices of things are expected to rise. And so I don't see how gold doesn't eventually get reintroduced back into the financial system. So that being said, I'm not giving any sort of financial advice whatsoever, but I definitely will be adding gold and most likely silver to my portfolio again going into the future. Just because it's these currency markets, these bond markets, stock markets, everything is looking shaky right now. And you know, the system we've been living with and we've been thrust into, like we've been living beyond our means because we've been able to pull progress and funds and whatever else into the present at the expense of our own future with this monetary system that we have. And that's why we've had some of the best standards of living worldwide, and that's because of the fiat monetary system. So even though it has its massive problems, which I will definitely admit it does, it's been able to bring us to this point in time by improving the standard of our lives, but at the expense of our future selves. You know, it's an unsustainable system that is showing massive cracks, and I'm going to be preparing for some sort of meltdown or some sort of crash, because it's only a matter of time, man. All you have to do is look at the news headlines and see the trends that we're going. So yeah, thought I'd discuss that in today's video, because you know, it's better to be prepared than not be prepared for the freezing of financial markets or even the breakdown of financial markets. Hopefully we don't get there, but man, the trend does not look good. Yeah, so I don't want to say that the US dollar will lose its reserve currency status, because if it does, there will be a ton of turbulence in that time period. But yeah, I'm going to be prepared for that scenario just in case. So yeah, thanks for watching, guys. If you like this video, like it, comment down below what you think. Am I out of place here by thinking the things that I do? And also share with anyone you think might enjoy the information in this video. Not enjoy the topic of conversation, but at least appreciate everything that I'm saying. And anyways, I'll see you guys in the next one. Thanks for watching.